Two investors, same starting capital, same brokerage, same year. Both watch the semiconductor index. It rallies 60%. The first investor holds the index directly. By the end of the year, they are up 60%. The second investor wants more. They put their money into a fund advertised as 3 times the daily return of the same index. By simple arithmetic, 3 times 60 is 180. The fund returns 90. Half of what was promised. For every $10,000 invested, 9,000 are missing. Not lost to fees, not lost to interest, not lost to a bad bet. The bet was right. The index went up. Where did the money go? To find the missing money, we have to look at what this fund is actually doing. The standard way to get 3 times exposure to an index is to use leverage. Take $100 of your own, borrow $200 more, buy $300 of the index. For one day, this works perfectly. If the index rises 1%, the $300 position rises by $3. On $100 of equity, that is a 3% return, 3 times the index, exactly as advertised. But something happens overnight. By the close of that first day, the equity is no longer $100, it is $103. To remain at 3 times leverage, the position must now be 309, not 303. The fund must buy more stock, at the new, higher price. The next day, suppose the market falls. The position shrinks faster than the equity does. To remain at 3 times, the fund must now sell, at the new, lower price. Buy at the high, sell at the low, every single trading day. This is not poor judgment, it is a structural requirement. To deliver 3 times the daily return, the fund must reset its exposure to 3 times at the close of every session, and the only way to reset is to trade. The mathematics of that reset is where the missing money lives. Begin with a unit of wealth, a single dollar, drawn as a square. Each trading day, the market delivers a return. That return stretches one side of the square. Day 1. The market rises 10%. The horizontal side stretches to 1.10. The square has become a rectangle. The new wealth is the area of that rectangle, 1.10. Day 2. The market falls by the same percentage, returning the index to where it started. The vertical side compresses to 0.90. The rectangle is now 1.10 by 0.90. The market is flat. Up 10, down 10. The arithmetic average return is 0. But the area of the rectangle is 0.99. The market went nowhere. Your money did not. 1% gone. To no crash, no bad call, no event at all. Just the up and the down. The order is irrelevant. Down 10 first, then up 10. The rectangle is the same. The missing corner is the same. Up then down then up. Both pay the same toll. Here is why. Consider the same total amount of stretching distributed differently. If both days had been flat, 0 return both times, the sides would each be exactly 1. The rectangle would still be a square. The area would be 1.00. Same arithmetic average. Same total amount of stretching. Different geometry. The square has more area than the rectangle. This is true in general. For any 2 numbers that add up to a fixed total, the rectangle whose area is largest is the one whose sides are equal, the square. Any deviation from squareness costs area. That missing area, the corner the rectangle has failed to fill compared to the square, is what the market's volatility has cost you. It is not an arithmetic loss. The arithmetic average return is exactly 0. It is a geometric loss. The penalty for the market refusing to stay still. Run the same exercise for many days. Each pair of moves draws a slightly elongated rectangle. Each missing corner is small, a few hundredths of a percent, invisible day to day. But they stack. 10 days of 2% daily moves, the index has gone nowhere, and the missing corners add up to 0.2%. Almost nothing. A year of 2% daily moves, 5%. The market is flat. You are down 5%. There is a name for this. It is called volatility drag. The missing corner has a precise size. When the market goes up by R and then down by the same R, the rectangle has sides 1 plus R and 1 minus R. Multiply them. 1 plus R times 1 minus R equals 1 minus R squared. The unit square had an area of 1. The rectangle has an area of 1 minus R squared. The missing corner is exactly R squared. R could be positive or negative. R squared is always positive. Up moves and down moves cost equally. The reason it is R squared and not just R comes from the shape of the growth curve itself. Compounding bends downward. Pick any two returns on a downward bending curve. Draw a straight line between them. The line lies below the curve. The line's midpoint is the average of the two outputs. The curve's value above 0 is the output of the average return. The average of the outputs is below the output of the average. That gap is the missing corner, the same quantity viewed from a different angle. Its size is 1/2 times the curvature of the curve times the variance of the swings. The wider the swings, the wider the gap, quadratically. Now apply leverage. A 3 times leveraged fund stretches each day's return by 3. A 10% move becomes a 30% move. The rectangle's sides are now 1 plus 3R and 1 minus 3R. Multiply. The missing corner is 3R squared, which is 9 times R squared. 3 times the leverage, 9 times the missing corner. The drag scales as the square of leverage. This is what most people get wrong. They expect a 3 times fund to have 3 times the drag. It has 9. But there is one more correction. A 3 times fund promises 3 times the index's return, not 3 times its compound growth. The index itself already has a small missing corner. What the leveraged fund loses over and above 3 copies of the index is the difference between 2 missing corners. 9 times R squared minus 3 times R squared. 6. 6 is 3 times 2. For any leverage L, the answer is L times L minus 1. 1 times 0, 2 times 1, 3 times 2. 0, 2, 6. Not the square of leverage. Leverage times leverage minus 1. Putting it together. The expected compound return of an L times leverage daily rebalanced fund equals L times the index's expected return minus 1/2 times L minus 1 times the variance per period. Plug in numbers. A 2 times fund, 2% daily volatility, about 9.5% annual loss on a flat market. A 3 times fund, 2% volatility, 26%. A 3 times fund, 4% volatility, semiconductor territory, 70%. 70% of your wealth gone on a market that went nowhere. The first place to look is the technology index. This year, the Nasdaq 100 has risen by roughly 35%. A 3 times leveraged fund tracking that index should, by simple multiplication, have returned 105%. It returned around 66. For every $10,000 invested at the start of the year, 38 percentage points of return have gone missing, roughly $3,800 per 10,000. Not stolen, not earned. Drag. Why is the gap so much bigger for the second fund? The daily moves of the semiconductor index are roughly twice the size of the tech index. The formula squares them. The daily drag is 4 times larger, and compounded over a year, the gap explodes. The semiconductor index has rallied close to 60% over the same period. A 3 times leveraged semiconductor fund should, by the same arithmetic, have returned 180%. It returned around 90. Half of what was promised. $9,000 per 10,000 invested, on a directional bet that was, in every sense, correct. These are real funds in a real year, but the formula tells us something more striking still. Suppose the index goes nowhere, up some days, down others. The arithmetic average return is exactly 0. but the daily moves are large, 4% each day. Semiconductor territory. Plug in. L equals 3. L times L minus 1 equals 6. Variance, 4% squared. Daily drag, almost 0.5%. Compounded over 250 trading days, the fund loses 70%. The market did nothing. The fund lost almost everything. This pattern is not unique to leveraged funds. Wherever a quantity grows or shrinks through compounding, wherever a small input has an outsize effect on the output, the same shape appears. The price of a bond plotted against interest rates, the price of an option plotted against the underlying stock, the path of a leveraged portfolio plotted against time. All three curves bend. All three pay the same tax, variance, multiplied by curvature, divided by 2. There is a name for this principle, and it predates the markets it now governs. Jensen's inequality. The average of a curved function is never equal to the function of an average. The line through 2 points on a curve always disagrees with the curve between them. The only question is which side it lies on. Volatility drag is one face, bonds wear another, options wear a third. The market is full of curves, and every one of them is paying the same tax.